to Market Overtime. I'm Oliver Renick. From tax tricks to pot stocks, from small cap to international value, today's guest is an ETF innovator and an expert equity market analyst. Meb Faber is a co-founder and chief investment officer of Cambria Investment Management, whose flagship fund, SYLD, recently passed $1 billion. He's here with us to talk about the macro outlook into year-end and a new way for investors to realize gains at a lower tax rate. Meb, great to have you here on Market Overtime. Good to see you, sir.
Thanks for having me.
Let's start by talking your new fund. You got a bunch at Cambria, obviously, but this one's particularly appealing, I think, in a time when we've had some big run-ups and giant stocks, big winners. Walk me through the process behind tax, which, as I understand it, basically is a way for people to take and realize gains without having to go through the usual tax pain of doing so. How do you navigate that? What's the trick?
Yeah, look, everyone hates taxes, and if we know anything about the ETF structure, to borrow a phrase from Mark Andreessen, we feel like ETFs are eating the asset management industry. And every year, if you look at the flows, they're going into ETFs and out of traditional high-fee, tax-inefficient funds. Now, that's been going on for a decade, maybe two. And the ETF structure versus like a traditional mutual fund or hedge fund structure, it's a big difference. You know, this tax efficiency. SPY, which launched in the late 90s, hasn't paid a capital gain distribution since it's been around, so 20 plus years. And that's a difference of probably 70 basis points, almost 1% just from the structure alone. So that's well established. So everyone kind of understands that. But you hit on a pretty important realization. Look, it's been an amazing 10 to 15 years in the US stock market. We did a poll on Twitter recently where we asked people, how much do you think the stock market has gone up since the bottom in 2009? And the answer is almost a 10-bagger, right? Amazing. So a lot of people hold highly appreciated positions. So forget about the people that have held, Microsoft for 20, 30 years or Google or something, but even in the past 10 years, sitting on big gains. And the problem that creates often is people end up with highly concentrated positions, but they say, Meb, I have half my portfolio in Microsoft or something, but I can't sell it because the tax man would kill me, right? They want to diversify, they want more balance, but they can't. Well, there's been solutions for that for 100 years for really wealthy people. By the way, if you think of how people have made generational wealth in real estate, the 1031 real estate exchange, and in stocks, there's been something called an exchange fund. Well, if you're a client of Goldman or Morgan Stanley, you got to be accredited or qualified. You can contribute your appreciated stock and you go into a fund of other people that contributed. The problem is you got to hold it for 7 years. And also traditionally, they've been very high fee. We're talking 1.5% just to set it up. And then they're probably going to ding you 1.5% per year. So it's not a great solution. So what we've been able to figure out with our friends at ETF Architect, Wes Gray and his crazy crew, is there's been something kind of like a 1031, but it's called a 351. And so, all right, a lot of jargon. What does that mean? These have been around for over a decade. There's been 100 of them that have happened. But if you think about transitioning, so you've seen a lot of mutual fund to ETF conversions. DFA did 50 billion. There was 100 billion last year. There's probably been 100 of these that have happened. You've also seen a few asset managers take their own clients and say, hey, I got 100 clients. I'm going to transition these individual accounts to an ETF. And then the next step, I said, well, why limit this to only, the accredited, the qualified people? Why can't we do this open enrollment? And what I mean by that is say, all right, we've launched 16 ETFs, been around for over a decade, but say, why not for our next one? Why don't we let people seed it? So you, your mom, your friends, whomever it may be, say, hey, look, I got this portfolio. I want to seed the ETF. And then after the ETF launches, instead of these 5, 10, 100 positions, all of a sudden we'll have just this ETF. So it's a way of taking a bunch of appreciated stock, contributing it to the ETF, not being a taxable event. Tax should launch in December. This is our first go around, so we're learning the ropes a little bit, but we're really excited about it.
This is pretty cool. I mean, it really is different, right? Like the idea, essentially it's formed in the idea, it's based in the idea of swapping assets to avoid the tax penalty because there's existing a legal structure for that. In the ETF form, then, do you know what will be in the ETF, and how will you figure out how to match what's coming in with then what's going to stay in the fund? Like, is it almost like a crowdsourced holding basket then?
Oh dear God, no. All right. So a couple comments real quick on
Yeah.
just FAQs. So you can't just, if you got 100 million NVIDIA, you can't just submit all NVIDIA. So there's two diversification rules. Top five positions can't be over 50%, and the
Okay.
top one can't be over 25%. But it's look through. So if you own only SPY, for example, you could submit an entire portfolio of SPY because it's look through to the underlying positions. And let's be clear, this is also not a tax wash, right? Like we're not just washing your gains. It's just a deferral.
Right.
So, you take this concentrated portfolio, you end up with this diversified ETF. This is going to be the first of three funds we have planned, and probably more after that. And they'll launch every 3 months or so. The first one is a unique strategy. We wrote a paper about this over a decade ago. And the theory was that you'll see that we've been thinking about taxes for a long time. The theory was that if you're a high net worth investor, or even just a taxable investor in a state like mine, California, New York or somewhere, and you have a taxable account, theoretically, you don't want a portfolio that has a bunch of dividends in your taxable account because you have to pay taxes on those each and every year. And so forget about a portfolio with high dividend yield. So we did a simulation a decade ago where we said, all right, what if you could match the returns of the S&P but with no dividends? How would that do? And it turns out after tax, and it's just mathematical logic,
Yeah.
that you'll do better.
Yeah.
And then we said, okay, well, what about a dividend portfolio instead of a 4, 6, 8% dividend yield, high dividend yield? What if you could match those returns, but with low or no dividends? And same thing, it turns out if you just do a little basic value strategy, quality, we call it shareholder yield, but with no dividends, just a basic strategy on an after-tax basis, you can outperform depending on your tax status by a little bit or a mile. So this fund tax is going to do 100 stocks. It'll be U.S. stocks, focused on companies that pay almost no dividend. There may be some in there that pay a tiny bit, but really trying to get close to zero, but still have those characteristics of stocks you want. So high quality, cheap, a lot of cash flow, buying back shares, but ended up being a portfolio. And then fund two and three will be different. Fund two will be a diversified ETF portfolio. Fund three will be global shareholder yield. But basically, it's this open enrollment that will happen on a consistent schedule that lets investors pick and choose which strategy they want to contribute their underlying positions to.
Okay, so the first goal basically is to get the taxes related to the fund down as low as possible, so you avoid the dividends. And then the other core component, to your point about not being a wash, it is a way to get away from super concentrated positions while still holding an equity position overall. How do you envision people then, what's their move after? Let's say they need to divest some of the, I don't know if that's the word, but they want to divest one of these big holdings like an NVIDIA or something, as long as it stays under those caps. What do you envision them doing with the tax fund after they own it? Then what is it, what's kind of my plan for that in my portfolio?
Hopefully they hold it for many years and pass it along to their children who then hold it
Okay.
for many more years. But it's up to them, if they choose to sell it, they can. And, then at that point they'll realize their tax payment. And that's the thing about taxes, right? Eventually the IRS will not be denied. We believe every citizen it's their duty to pay every cent of every tax they owe, but also it's their duty to their family and their community and themselves to not pay more. And if you want to volunteer and pay more taxes, you certainly can. I've never met a politician who talks about this. When I ask them, I say, well, do you voluntarily pay more taxes than is required by law? And none have said they do. So to me, this is just a way to be thoughtful and intelligent about a portfolio that may be off kilter or off balance, where it may not be the portfolio you want. I've heard so many times over the years, we had a family friend that said, I have all this GE, I just can't sell it because the tax man will
Totally.
kill me. And then guess what? GE goes down 70% and
Totally.
solves that problem for you because, you never sold it. And so getting to a more balanced position, and this applies to financial advisors too. So if you're a financial advisor with 100 clients, you can easily transition them to this new ETF. If you're in direct indexing, the problem with direct indexing, which is a wonderful strategy, is eventually you end up with a lot of highly appreciated concentrated stock positions,
Mm,
and then you're kind of stuck. And so in
mm.
this scenario, it's a nice off ramp for something like that to give you a more diversified portfolio in return. And again, the cool part, there's plenty of prior art. This has happened over 100 times already. Our innovation is we're just kind of opening this up to everyone as opposed to just, people behind the velvet rope.
No, it's great, especially after what happened with NVIDIA and the super concentrated market. I've heard the same thing from tons of friends, guests, et cetera, who are in that spot where they've got massive heaps of return, but they're kind of stuck in it, right? So you're going to have basically 100 stocks. Will you consider the performance of the fund a success if it can just match the S&P 500 after your tax benefits? So maybe it underperforms a little bit, but in the worst case scenario, as long as the tax nets out to even with the S&P, is that basically a success?
You're asking a quant this question, but I'm going to give you a spicy answer.
Okay.
The S&P here in 2024 looks pretty expensive, and it doesn't matter which valuation metric you use. The Achilles heel of market cap weighting historically has been when the positions go up a lot, the biggest names in the index tend to get expensive. Now, this usually only happens in big booms and bubbles, but if you look at any valuation metric in the U.S. stock market, it looks like the broad market cap is expensive. Now, that doesn't mean it has to go down, it doesn't mean it has to crash, and it doesn't even mean it can't keep going up. It just means, on average, we think the S&P is probably going to have muted returns going forward. So looking at a value approach and looking at some of the value spreads, for many of these companies that are high quality, it looks like a pretty opportune time to be investing in something other than the S&P 500. So yes, we would be happy to just match it, but my hope and belief is that this will probably outperform on a nominal pre-tax basis as well
Okay.
in the years going forward. May not happen this quarter, may not happen this year, but over the next 5 to 10 years, we're feeling pretty good about this type of portfolio versus the market cap index.
Okay, so that would be the cherry on top. But even for it just to make sense at the base level for someone to do this, if it's the post-tax equivalent of the index and it's baseline success, if you can outperform on top of it, then that's like, a really nice bonus, the cherry on top. When you're avoiding dividend payers, though, do you have to put on like a different hat than usual, Meb? Because a lot of your funds are pretty yield focused, obviously.
Yeah, if you look at the characteristics, the beauty of having a menu of thousands of securities, if you're only buying 100 or 200 of them, is you can concentrate and kind of design in what you want. And so when we did this historical simulation, it demonstrated that, yeah, you could do this because we didn't know going to, and actually, there's not that much in the academic literature about tax optimized returns acknowledging the ETF structure exists. So most of the academic literature assumes you're doing this in a separate account or a mutual fund, where if you're trading, you're generating capital gains. But because of the ETF structure, that's not true. So then it allows you to kind of come up with some new ideas that have turnover that can target a certain strategy that will give you tax efficient portfolio. And so when we wrote this paper, there was literally like nothing else out there. And so we've run it forward since then, and it looks really interesting from a value. I'm dyed-in-the-wool value guy, but quality, we do a sprinkling of momentum on the end. But really, it gives you this portfolio. It's probably going to look pretty similar. In the US, the shareholder yield portfolio we have, a large portion of that is driven by buybacks. And so buybacks being the default substitute
For a
for
dividend.
dividend yield in
Yeah.
the US because it's more tax efficient and more flexible as well.
So then, what's the risk? Is it just that, let's say I've got a big position in like an NVIDIA concentration, so then I want to get a more diversified approach. NVIDIA keeps ramping, the market gets more concentrated, and the spread widens out, and I like underperform. Is that then just kind of the only risk, basically?
I mean, look, there's always that challenge. And we tell investors, one of the struggles, everyone wants to think in binary terms. Should I buy gold? Should I sell it? Is the market going to rip or is it going to crash? Is NVIDIA going to 10 trillion or is it going all the way down? And so we often tell people, we say, look, you can diversify your outcomes. If you got a big position in NVIDIA, you can get rid of half. or get rid of a quarter of it, or get rid of a quarter once a year for the next 4 years, whatever it may be, to diversify your emotional outcomes in the future. Having a happy psychology where you can sleep at night, I think is a lot more important than optimizing the return, because you want to get to the finish line. You want to succeed and you want to survive. And so that path is also a thoughtful one, where we tell people that dollar cost averaging in or out of a position, totally okay as well.
Okay. I don't know if there's an answer to this or whether it's even worth asking, but more kind of like a philosophical question, Meb, on like an infinite time frame. Does the market naturally get concentrated, like in the dog-eat-dog world of capitalism? Like, should we expect the index to get more concentrated over time, or do you think what's happened over the last 2 years is sort of an abnormality?
If you look at the history of global markets, we actually just chatted with a friend on this topic yesterday who was examining the US market for a few hundred years. And he said, look, this is near or at the highest concentration ever.
Yeah.
But so what? What does that mean? If you look at some countries, if you look at like Finland, if you look at Denmark, there's been places where a single stock has been 70% of the index.
Wow.
Now, the US as a percentage of the world is 2/3 right now. So the 10 times the size of any other country's stock market, including Japan. But, there's been other periods where the US wasn't the biggest stock market. In the 1980s, Japan was the biggest stock market. And so these things kind of have a way of moving. And if you look at like sectors, for example, that's my favorite example, where you say concentrated energy at one point was a third of the S&P. It bottomed out a few years ago at 2% of the S&P, and now it's like 5. So, you have these different regimes of value growth, high interest rates, low interest rates, inflation, disinflation, booming markets, depressed type of markets. And so that has a way of, look at China over the past 30 years. You've had no market that's been more schizophrenic as far as all-time highs, back down low, super high P/E ratio of 50, all the way down to 8, and back and forth. And so I think having that diversified global exposure is important. And if you get too concentrated, that tends to be it can be a very painful place if those concentrated positions do poorly.
Okay, I like that. It's a really interesting subject, particularly kind of when we're in this AI bias of the moment. I'm like thinking about the singularity, but it doesn't really work like that. The last time the market was this concentrated was basically in the 70s, but then it was like the concentration broke apart, whereas this time it's been increasing. So it's a really interesting study in the perspective. All right, so the 351 ETF, the tax exchange, TAX, the ticker. Let's talk some macro while I got you, Meb. Thinking about generally where we are right now, it's a pretty interesting setup. We just cut rates 50 bips. We got the election coming up. What's kind of the main thing on your mind as you're considering sort of the independent variables for the market? Like what matters the most right now?
Well, historically, the winner of the election, the best indicator you can possibly use is actually the stock market. And so the stock market predicts like 85% of presidential election winners. Is the stock market up in the 3 months going into the election? The incumbent party usually stays in power. Now, this is a little weird because you got sort of a different, the president is not running on we'll see what happens. But if you're on the Trump team, you're cheering for the market to go down. If you're on Team Democrat, you're cheering for the market to go up. But we'll see. It's not 100%. But yeah, looking at markets, looking out in the future, there's a couple common themes. The U.S. market cap is expensive. The good news, you can shift to U.S. stocks that are cheaper and high quality. You can shift to some foreign and emerging markets that seem to be doing really well. Same deal. You have some really nice valuations set up in those companies around the globe as well. If you look into real assets, we do a lot of momentum and trend work. Everything seems to be going up, with the exception of bonds, of course. But you have precious metals hitting all-time highs. Gold certainly is in that category. And you have the one area that's a curiosity to me and a head scratcher is if you look at fixed income. Historically, most risky bonds have a nice big fat spread to T-bills. So thinking corporate, junk, emerging market, on and on. And almost every fixed income market today has very little yield relative to T-bills. So for that to normalize, you need one of three things to happen. You need the entire curve of risky bonds to move up in yield. You need T-bills to come down, or both. But right now, there's not a lot of juice in many of these fixed income markets, despite how poorly they've done over the past few years. That's the one area that's a bit of a head scratcher to me. But for now, it's a bull market, baby, and everything's going up. So the trends look good.
Hey, to your point about bond yields, is that why the yield funds are picking up flows? You guys are getting close to, I think, like $3 billion total AUM. Do you think people are finding yield in equity now as an alternative, especially after what we went through in 2022?
It's always a curiosity on what people find interesting. Usually investors certainly are attracted to what's doing well, and our shareholder yield suite is, our 1, 2, and 3 biggest funds. Our second biggest fund, surprisingly, is emerging markets, EYLD. Given how poorly emerging markets have done for the past 15 years, this fund is picking up some pretty interesting names, pretty interesting. We often tell people, they say our US fund, SYLD, there's like, look, it doesn't have much tech value, bro. You're going to miss out on this tech run, this AI. But I say, by the way, you're right. But our emerging market fund, tech is actually the largest sector in that fund, and that surprises people. But I say, on average, the tech stocks there are much cheaper, and they're not doing all this share issuance like most of the tech stocks do in the United States, the stock-based compensation. So many of these companies have a negative shareholder yield because they're issuing shares. Even if they're buying them back, they're only buying them back to mop up all the issuance they're doing. So it just demonstrates that a strategy like shareholder yield is agnostic to sectors, and in some countries and regions, they find more opportunities in it sometimes rather than others.
Okay, really like that point, EYLD. Okay, Meb, you've got a fund section on your site, which is, by the way, just chock full of information, research, white papers for those who aren't familiar with your stuff. But one of the fun areas is the parts where you disagree with the market and you've got some contrarian views. One of them kind of overlaps with something I was thinking about around the Fed's last decision, which is whether or not we should even have an active Fed. It kind of reminds me of something Jim Bianco said some years ago, which is that you should just kind of have a lever based on the bond market, keeps the Fed agnostic. Tell me your thoughts on that, because it seems like you, I don't know if you're just kind of arguing this or if you feel that way, but should we set the Fed on cruise control to just do whatever Fed funds futures say?
Sure, let's do it. I mean, I think the challenge there, of course, is that most investors, they don't want a robot running it. Even though we've done a whole series of articles, hey, should CalPERS be managed by a robot? Should Harvard's endowment be managed by a robot? Should on and on. And the reality is the robots are getting pretty good, and rules-based type of strategies are great. And so you can pull up a chart of the Fed funds rate and the 2-year bond yield, which is a free market sort of yield that trades, and they're almost always neck and neck, and they may diverge for a little bit. And so the 2 year has been much lower than the Fed funds rate for the past cycle, year or two, but they eventually catch up to each other. So we joke they should just they should do it, but I feel like investors would be a little too nervous having that be in charge of they like following Jay Powell and Greenspan back in the day, listen to what they have to say. They want to believe someone's really smart and in charge, but I honestly don't think it matters that much.
Does it depend on how one feels about the wisdom of crowds? I mean, generally that's kind of why they work, right? More times than not, the wisdom of crowds work, but do we need someone there, a ballast, to try and keep us guessing so that the markets, don't go in circles?
Yeah, who knows? We got an old quote that we post on our quote of the day on Twitter from Greenspan, where he's basically like, if you understood me, I wasn't speaking. You must not have understood me because I speak in riddles, basically. And so I mean, look, the market eventually gets it right, and so the beauty of the Fed commentators is they can never be proven wrong, because you can look back and say the Fed is stupid. Rates have been too low, too high, whatever you want to call it. And when something goes wrong for the next year, you can say, see, it's their fault. And there's no way you can prove the counterfactual because we only have one history. But on average, look, I think the market eventually clears and we figure it out. That having been said, and we launched a fixed income fund based on this year called TYLD, where it only invests in all these different bond categories if and when they have some yield relative to T-bills. And so this is a curious time because historically, it's a terrible idea to invest in all these bond markets when they have low yield. And right now, that fund is sitting 100% in T-bills, so it's not finding a lot of opportunity elsewhere in the fixed income space.
Hey, to your point about things generally all going up right now and the economy continuing to surprise positively for the most part, haven't hit the NBR-defined recessions just yet. Do you think we should give Powell a good rating? What do you think is his score right now? Because it seems like if there's a power switch in November, his job term may be limited.
You know, it's like the politicians and then also the people in power like Jay Powell, they have a tough job because they love to claim responsibility for the stock market or the economy. And let's be honest, it's mostly out of their control. So if you inherited the stock market in December 1999, it doesn't matter what you're doing. It was trading at the highest PE ratio in the history of the US market. Like, that's a headwind. So too bad. Like, it's going to take a decade or two for that to work off. And vice versa, if you started a period like the early 80s or, 2009 is not maybe as good of an example, but, periods where stock market's cheap, on and on, like you're inheriting it, a great situation. And so, they love to take credit for things they don't have anything to do with. But, again, if the Fed just got around, watched Seinfeld episodes, reruns, drank a six-pack of beer, and pegged it to the 2-year, I think they'd do just fine.
All right. Hey, Meb, fun chat. Glad we got the details on the new fund. Very interesting. I think it's going to answer a lot of questions for people who've been trying to navigate that situation after big gains. Appreciate your time as always.
It's been a blast. Thanks, bud.
All right. You got it. Meb Faber, co-founder and CIO, Cambria Investment Management, coming up to $3 billion under management. Go check out the funds. And thank you for watching Market Overtime. Be sure to subscribe to the Schwab Network YouTube page. By the way, I'm Oliver Renick. Thanks for watching.